The S&P 500 pulled back nearly 5% on fears of a second wave of COVID-19 cases. Hello and welcome back to the Wall Street Petting Zoo, your source for market news and education. I'm Christopher Smith.
And I'm Robert Coburn. And last weekend, we got news over the weekend that several states were seeing a new spike in coronavirus cases, including Arizona, which had already run out of ventilators and ICU beds. Doctors described Arizona hospitals as being like a war zone, and there was plenty more bad news where that came from. Oil prices dropped slightly on Monday as Libya restarted production at its oil fields, which have been shut down due to civil war for several years. Also, bankruptcy data revealed that a new wave of retail bankruptcies is starting to hit as landlords end their rent deferment periods. Despite the bad news, the S&P 500 gained over 1% on Monday, probably on the news that the Federal Reserve was expanding its stimulus program for small businesses.
Yeah, and then Tuesday, the S&P 500 pulled back a bit, but the Nasdaq moved higher. Usually these indexes move together, but occasionally we see some divergence between them. The day's news included some positive animal trial results for the antiviral drug remdesivir in fighting COVID 19, so that's positive news. We also got some small business sentiment data that beat analyst expectations, which suggests that Congress's modifications to that Paycheck Protection Program that helps small businesses have kicked in and have been effective in helping save some of those small businesses that are threatened by COVID 19.
And then Wednesday, we had another mixed day, with the Nasdaq moving higher as S&P 500 pulled back. A large crude oil inventory build caused the oil rally to weaken a little. Starbucks posted a wider than expected loss on its earnings and announced that it plans to permanently close 400 stores in North America. There was some good news on the coronavirus vaccine front, as Johnson & Johnson announced that it will begin human trials earlier than expected in late July. Travel stocks weakened on news of a big downgrade from JP Morgan. The investment bank said that the rally in airlines has gone too far and too fast and can't last much longer. However, movie theater stocks moved higher as AMC announced plans to reopen theaters globally in July.
Yeah, and then Thursday, of course, we got a huge market sell-off with the S&P 500 falling nearly 6%. The move was driven partly by renewed fear of a second wave of lockdowns as coronavirus cases rise in several of the largest US states, and as the national case count hit 2 million. Investors may also have been concerned by reports that a no deal Brexit looks increasingly likely. If Britain exits the European Union without a deal, that could cause all sorts of trade disruptions. And adding to these woes, we got some weaker than expected inflation data and some numbers showing that private debt in the US surged almost 12% this quarter, even as the number of credit rating downgrades shoots through the roof. Travel, oil, and bank stocks led the way down with a nearly 10% drop. Real estate stocks were also hit hard on news that housing prices are falling and that mortgage default rates are rising as loan deferment programs expire. And it's also looking like there's just generally a lot of debt risk out there. So I think that the market is sort of finally waking up to the debt risk that exists in the market, and this sell off reflected that.
Yeah, and as the sell-off started Thursday morning, U.S. Treasury Secretary Steve Mnuchin went on to TV to reassure investors that there will be no more shutdowns this year and that the Fed plans to continue pumping trillions of dollars of liquidity into the system. But apparently investors were not reassured. The market also didn't rally on news that Moderna plans to start phase 3 human trials for its coronavirus vaccine in July, with plans to manufacture 1 billion doses by the end of the year. Ford took a particular hard hit Thursday on news of a large vehicle recall, but surprisingly, Amazon outperformed the rest of the market despite news of a huge antitrust lawsuit against the company in Europe.
Yeah, and then Friday, the S&P 500 opened sharply higher as retail investors bought the dip on Thursday. But it sold off midday and dropped into red territory by about noon. And then it rallied in the last hour of trading to end the day up nearly 1.5%. So quite the roller coaster of a day on Friday. We got some really positive consumer sentiment data on Friday that beat analyst expectations and helped lift the market. And we also got a positive economic forecast from the ECRI, which so far has been pretty accurate at forecasting this recovery about 6 months out. So that's a really positive, some really positive news there that ECRI sees this recovery continuing 6 months from now. Robert, let's talk stocks we watched last week. What were you watching?
So this week I was watching airline stocks, and as I predicted last week, they pulled back from those big gains they saw the previous week, but probably for a different reason. I was only calling it out as as a normal trend, like you expected it to come back. But then when JP Morgan came out and basically was like, well, this is happening way too fast, way too quickly, it quickly went down after that. But other than airline stocks, I was also watching Bitcoin. Bitcoin teased the 10,000 mark again, but then it fell back down to around the 9,000 mark, and I think it's roughly like 9,500 right now. So still haven't broken back above that 10,000 mark, but probably won't happen probably till like July. Probably, I'm predicting. What about you, Chris? What were you watching this week?
Well, last week I forecasted that the Nasdaq would beat the S&P 500 this week, which it did quite handily. It beat it by about 4%. The Nasdaq still pulled back a little bit, but didn't pull back nearly as much as the S&P 500 did. I also was watching for buying opportunities on Applied Materials and ExxonMobil, and I definitely got those buying opportunities as Applied Materials pulled back 6% and ExxonMobil pulled back 11%. Stocks we're watching this week. What are you watching this week, Robert?
So this week I'll continue to be watching the airline stocks, which I know will probably dip even lower following this down week. But I know if they dip it low enough, I probably will end up buying, mostly because the government, they have a tendency to bail out the airline industry. I mean, it's already happened twice in the last decade. Actually, it would technically be about 12, 13 years, so a little over a decade. But on top of airline stocks, I also be watching video game stocks, with Sony revealing the new PlayStation this past week. Both Sony and Microsoft will be going to war again, with those two consoles set to launch by the end of the year. It's been 7 years since the last console war started, and competition is always good for business. What about you,
Yeah,
Chris?
I bought a little Microsoft recently. It's been pretty hot, I suppose, partly because of that console war. Well, on Friday, analyst polling from FactSet showed that the utility sector is the strongest, expected to be the strongest earnings performer in the pandemic environment. Analysts are expecting the sector to take only a 1%, 1.6% earnings hit this year. And utility stocks are still relatively cheap right now compared to their pre pandemic prices. So I think that is probably a sector to buy in this environment. I picked up some RYU, which is an equal weight utilities ETF. This was a hot sector last year. Most of the companies in this sector beat analyst expectations on earnings last year. I think that it will continue to boom during the pandemic. I've seen a surprising amount of continued interest in renewable energy. India announced this week that it's making a $6 billion investment in renewable energy. So I think that the energy revolution is going to continue, and utilities are going to continue to be hot. I'm also watching some pharmaceutical companies: Merck, Bristol Myers Squibb, and AbbVie. Both Merck and Bristol Myers Squibb announced FDA approvals this week for expanded labels on some of their top drugs. Both companies have pretty good valuations, and I think they're both strong and well-managed companies that should continue to grow over the next few years. And then AbbVie had a bunch of good news this week, including a victory in court to protect its drug patents. It also made a deal with Genmab to develop cancer antibodies, and it got some positive clinical trial data for a rheumatoid arthritis drug. AbbVie has been definitely rising lately, and it's near the top of its channel, but I wouldn't be surprised to see it actually break out of its channel and move even higher from here. So I bought a little bit here, and if it dips, I will be buying more because I think that AbbVie is a really strong dividend stock with a strong future. However, I do want to point out here that we got a really important technical signal this week when the MACD crossed its signal line downward. We haven't done a video on MACD, but we'll have to fairly soon because seasonal investors use this technical signal as their cue to exit the market in June and then stay out of the market until October. So this sort of signals the beginning of the weak season in the stock market, I think. I'm not sure what the seasonal investors will do this year. Obviously, it's a weird year with everything that's going on, potentially more stimulus coming in July, but we may see a very significant weakening of the market going forward. My experience trading this is that you can make money from investing in the weak season in July, August, and September, but it takes a different mindset than the rest of the year because the dips are deeper than the rest of the year. So you have to wait a little bit longer before you buy the dip in this weak season. So it's time to start getting more careful, I think, about all of that dip buying and look for steeper drops in the market before you get in. Hey, folks, if you heard anything useful on the podcast this week, please give us a like, share, or comment on YouTube. It's your devoted listenership and your sharing this on social media that helps us get the word out since we don't do any advertising. Um, Also, we have a referral link underneath the Weeble. Referral link to Weeble beneath the YouTube video.
Blah, blah, blah,
If you
blah,
click
blah.
that, if you click that and deposit $100 into a Weeble account, that helps us support the podcast. We'll get a couple free stocks, and you also will get a couple free stocks. So, what can it hurt to go open a Weeble account and get yourself some free stocks? And folks, we will see you back at the zoo next week. Thanks so much for listening.
See ya.